$2. That's the difference between a couple paying $700 a month for health insurance and the same couple paying $2,700. Same ages, same plan. By the end, you'll know where that line sits and which side you'd land on. $2 of income apart. And if what you want is to retire before 65, that gap is the thing actually standing in your way. Not your savings, not the market. The claim goes like this. If you stop working before 65, you lose your employer health plan. Medicare hasn't started yet, and the gap you bridge yourself is expensive enough that you simply keep working until Medicare picks you up. That belief has a name: job lock, staying in a job you could afford to leave purely to keep the insurance attached to it. Government auditors were writing about it in workers aged 55 to 64 back in 1998, and it has not moved an inch since. And it doesn't catch the people with too little money. It catches the careful ones, people who've run their numbers more than once, who are close enough to the finish line to see it and cannot get comfortable with one unknown. So they give it one more year, then another. And almost none of them know this. There is a line. Nobody hands it to you. Almost nobody knows where it sits, and which side of it you land on matters more than the size of your savings. So I ran the actual cost, not an estimate, the real premium from the marketplace pricing tool for one specific household. The household, a married couple, both 60, no coverage from a job, shopping the same mid-level plan in the same zip code. The only thing that changes between the two runs is income. At just under $85,000 a year, that couple pays $702 a month. Government help covers most of it, nearly $25,000 a year. Now add $2, not $2,000, $2 a year. The help goes to zero. Same plan, same two people. Now it costs $2,761 a month. Their health insurance just went from under 10% of their income to nearly 40%. But here is the strange part. The $2 didn't change the premium. The price of that plan never moved, $2,761 a month, both times. What the $2 changed was whether they were allowed any help paying it. They crossed a line. That is not a price tag. That is a tripwire, and a tripwire is a completely different problem than a wall. A wall stops everyone standing in front of it. A tripwire only catches the person who doesn't know it's there. So where is it? The line sits at 400% of the federal poverty guideline for your household size. Under it, you qualify for help, and the help scales with what you earn. Over it, by any amount at all, nothing. For that couple, the line landed at exactly $84,600, which is why $84,599 and $84,601 are two different worlds. For most of the last 5 years, that line did not exist. Extra pandemic-era help removed it and capped what anyone paid at a set share of their income, no matter how high the income went. That extra help expired on the 1st of January, 2026. The tripwire came back, and it is catching people right now. Kaiser Family Foundation analysis puts the heaviest impact on older middle-income households. People in their 50s and early 60s already charge the highest premiums in the market, which means the people most likely to trip over this line are exactly the people closest to being able to stop working. So the fear isn't imaginary. Cross that line and the number really does land on you. What's imaginary is the idea that it's fixed and that it automatically applies to you, because there's a version of this where you land under it. Same couple, same plan, a number you could actually build a year around. Most people never find out which version is theirs, because when people run into this, most don't go looking for the line. They take the path that asks nothing of them. They stay on the employer plan through the coverage the law lets you continue after leaving a job. That's COBRA. Same doctors, same card, except now the whole premium comes out of their own pocket instead of split with an employer. It's the expensive option, and they take it because it's the one that asks nothing of them. Or they start weighing going without coverage and hoping. People in their early 60s, with real money in the bank, seriously considering being uninsured, because the alternative looked unsurvivable. None of that is stupid. It's what anyone does when the only alternative is a number they can't verify, which is exactly why the number is worth verifying, because the marketplace doesn't price your insurance off your savings. It doesn't look at your house, your portfolio, or your net worth. It looks at one thing: the income you report in the year you're covered. On the paperwork, it has a name: Modified Adjusted Gross Income. And here's what almost nobody realizes about it. The money you spend in a year and the money you report in a year are not the same number, which is why two households can spend exactly the same amount, live exactly the same life, and report completely different income, depending on which accounts the money came out of. That's not a loophole. It's just how the form works. And it's the reason this line is something you can end up on the right side of, instead of something that happens to you. So what does that actually look like in a life? Easiest to see with two of them, side by side. Two people in identical financial shape. Two completely different lives. One retires at 65, right on schedule, because the insurance math looked impossible. 5 more years in a job they were already done with. The other one's the same age, with the same savings. But this one checks where the line sits for a household of two. Works out that the income they would show in the bridge years lands under it, and stops at 60. Same money, same plans on offer to both of them. The only thing that separated their two lives was knowing the line was there. And what the first one paid for not knowing was not premiums. It was 5 years of being 60 instead of 65. 5 years of knees that still work, of parents still around to visit, of grandchildren small enough to still want your attention. That is what this claim actually costs. And nobody ever sends you the invoice. Below that line, the help is not a token gesture. In that pricing run, it covered about 3/4 of the premium. That is the difference between a number that ends a retirement plan and a number that just sits in the budget next to groceries and the property tax bill. So why does almost nobody in this spot ever see that help? 2 reasons. And the second one is the expensive one to miss. The first is the thing we just covered. Bridge year income is often lower than working income anyway. You're not drawing a salary. And what lands on your return depends on where the money comes from. Worth a conversation with whoever does your taxes. The second is the cheaper tier sitting right there in the same marketplace. In that same run, under the line, it came out at $0 a month for the couple. The help covered the whole premium. You pay more when you actually use care. Far less every month you don't. Whether that trade works for a given household, nobody can say from the outside. But almost nobody stuck in the 1 more year loop even knows it's an option. Picture where that puts you. You're 58, you've got enough, or close to it, and the only thing between you and the last good decade of your life is a premium you've never actually priced. You sit down with a free public calculator, type in your household size and the income you would really show, and the number that comes back is roughly what you already pay through work. Nothing about your savings changed. Only what you knew. There are 2 catches here, and the second one decides whether any of this still holds next year. Above the line, the cost really is punishing. For that couple, the full price of the mid-level plan ran past $30,000 a year. In some states, higher. Landing just over that line by accident is one of the most expensive small mistakes a person in their 60s can make. And this is current law for this year. Not a permanent feature of the world. That line has moved before. It was gone for 5 years and it came back. So whatever you plan around it, you check against the year you actually retire, not the year you happen to read about it. And it's not a financial move. It's a look. Pull one number, the income you would actually report in the years between your last paycheck and 65. Not your savings, not your net worth. The income that shows up on your return. Then find where 400% of the poverty guideline falls for your household size and see how much room is between the two. Most people have never written that number down once. They've run their retirement total a dozen times and never once run the number that actually sets their premium. The claim was that you have to work until 65 for the health insurance. For a large number of the people who believe it, that is false. There is a line. It is knowable. And which side of it you land on is far more in your control than your savings balance has ever been. It was never a wall. It was a tripwire. And a tripwire only catches the person who does not know it is there. You do now. Tell me in the comments, had you ever heard this line exists, or did you assume, like most people, that the price above it was simply the price? If you enjoyed this, like this video and subscribe, because here we dig into the decisions that quietly shape when you get to retire. This is Nathan. There's always another claim worth testing. I'll see you on the Money Shift.